Hello viewers, welcome back. We are now on our lecture 2 or lesson 2, and this is our second class on cost and management accounting. We are doing cost and management accounting paper. So if you are doing something else, you better check other videos on the same channel that will take you to the different course units that we provide here at CPA Accounting Tutorials. Great. So what we are going to look at, we are going to discuss the discipline of cost and management accounting. In other words, we are going to internalize cost and management accounting as a discipline, because we are seeing that there are two things that we are handling. We have costs, and at the same time we have what we call management. So we need to look at those two disciplines and we'll be able to understand what they are meaning or why they are combined together. So this is going to be more of an introduction, even though we did an introduction on cost and management accounting, but we are going to talk about some items. We are going to repeat some things, the cost terms that we talked about. There are things to do with the cost object, cost ascertainment, so if you haven't watched it, you can go and have a look, because we have also classification of costs. So these are some of the terminologies that we spoke about in our first lecture. So, but before I proceed, let's agree that everyone joining our tutorials or our lectures today, you have the following items. Because we said everyone should have a question bank, and it can be either a hard copy or a soft copy. And we say the soft copy, you can access it from our Telegram channel, and the link is within this same YouTube channel in the about section. So you go there, download what you want to do, and be able to have the question bank with you, all the past papers. Because the reason as why I'm emphasizing on this is that I honestly believe and I assume that the only way for you to access passing or to assess yourself that you have understood a certain topic is by doing some numbers on your own. And that's why we really need these question banks. That's one of the major reasons why I'm emphasizing on that. For graph books, of course, we haven't discussed questions to do with graphing, but I also request that you get a graph book, you get a long ruler, a transparent one, because you will notice that when we are doing some numbers, you will actually need to draw some graphs. And I know those are very easy for you to get. So Now, what I want to start with without wasting time is how do we cost anything, or how do we cost a product or a service that we are working on. So this basically what I want to focus on, or to start with, is how do we cost something or a product. Let me just call it a product or a service. How do we cost a product or a service? So this is what we are going to be focusing on before we go any further. So we need to know how can we cost a product or a service of any company or an organization. So the general assumption, for those that went through our first tutorial or our first lecture, we spoke about the different things that we go through in terms of the costing. But the general thing, or the general assumption I want you to know, for those who haven't watched our first video, is that when you want to know, when you are costing a product or a service, if let's say I want to determine a cost of something, then the assumption is that I just need to add, you need to add up the costs that I have incurred. In other words, that's the general assumption. That's what I want you to take. As long as the question is saying, how can I be able to cost a product or a service, just have a general assumption that we just need to add up all costs that we've incurred in the production of that same product. Just like you make payment for these CPA papers. Maybe you are paying for cost and management accounting. So the costing would be the money you've paid, the money paid as exam fees, that you pay to the institute for any given paper that you want to sit. We shall also be able to add the money that we've paid to the tuition providers. The tuition providers, those that have actually given you the knowledge and the skill that you need for you to be able to pass the paper. In other words, the money you've paid to the university or the institution or the college, where you've gotten the information that you need that will help you to do the paper. And that would be your assumption for the moment. In the first place, I just want you to understand that if I'm getting a cost of something, of a product or a service, I need to just sum up all the costs that have incurred in the production of that product or service. And other things, we will get the details later. But at least you have that assumption. So remember, the subject you are dealing with is called cost and management accounting. The subject is called cost and management accounting. Therefore, the person who uses the skills and knowledge of how to cost something is the one that we call the cost accountant. So the person A cost accountant is the person who uses the skills on how to cost something, is the one that we call the cost accountant. And the process this person goes through, meaning this person goes through a process called cost accounting. So the process this person is going through is what we call cost accounting. And I hope you get my point from this perspective. The person who does the costing, or who uses the skill of how to cost something, is the one that we call a cost accountant. And the process he or she goes through is what we call the cost accounting. But the question is, how come that the course we are studying now is called cost and management accounting? Because if we are basically looking at the costs, then why do we call the course cost and management accounting? And there is a reason as why those SCA guys, for them, they call it performance management. Because this is not only looking at the costs alone, but we need to make decisions. So the course is called cost and management accounting because this means that we have two disciplines. Here we have two disciplines that are present. Two disciplines that are present here. So we are dealing with two things at once. So we are going to appreciate that at the end of the day, you as a cost accountant, you can't work alone in an organization. So there are things that even a management accountant will need from you. Because for you, you just uses the skill to, and you cost what we are doing. But there are people who are going to use your information. So the management accountant is going to be using your information. Therefore, we are saying that the discipline of cost accounting and a person, here we call that person cost accountant. And that's why at times when companies, they are advertising for jobs for a cost accountant, and when you try to look at the job specification or the job specification and the job description, in other words, when you look at what they are going to be doing, then you will see that some of the things that you are going to do as a cost accountant are the things that we are going to study here in cost and management accounting. And from here, you will also need the same skill like you are going to learn from this perspective. So being a cost accountant, you will need the same skill that we are going to study here. Now, cost Accounting is determining the cost of the cost object. We learned what a cost object is. We said it can be a cost center or a cost unit, and we went through those definitions. And that's why I told you to just take the assumption of adding all the costs that we've incurred. Because in cost accounting, the issue is all about determining the cost of a given cost object. It may be for a unit or for a given department or function. But now, as management works on costs, as management works with these costs that we've determined, or as the management deals with whatever they are producing, because when you are trying to produce something, there is a cost you are incurring. So the management, as they are trying to deal with whatever they are producing, you will find that they will have to take some decisions. They will have to make some decisions about what they are producing or about what they are doing. For example, they may say, yes, we know that maybe we are producing sugar. Let's just assume we are producing sugar. Then there are decisions that we need to take about the costs of sugar or the cost of sugar. It would be sugar, or it would be any other cost unit, or it may be a cost object that we are producing. So the decisions that we may take, the decisions by management may include, we may try to look at, to determine, one, we may try to determine the price of, let's say, sugar. Let's just use sugar as an example. Let's say the company is producing sugar and management wants to make a decision on price of sugar. How much are we going to sell our sugar that we are producing? And now the management will tell the cost accountant to provide the costs of, let's say, a bag of sugar. And of course, at the end of the day, we as management, we have to depend on our company policy on how we determine the price of our products or our sugar. In other words, we could look at what profit margin do we need to add, or do we need from this bag of sugar that we've produced. We may say that maybe the company's policy says we need 25% of whatever input that was used in the production process. So management will tell the cost accountant to provide that information so that they can be able to do the costing, the pricing. Because the cost accountant will only provide the costs incurred in sugar production, and that will be the end of his work. So it will be upon management to, based on the company policies, and be able to add a profit component so that they can determine the selling price of these products. The other item or the other idea in terms of the decision, it may be about planning. Management may be trying to planning and budgeting. Now, the management accountant may request the cost accountant to provide information relating to the quantity of sugar, because they want to look at the quantity of sugar they have produced. Quantity of sugar produced. For planning purposes, because you can base on these quantities for you to be able to set stock levels. We shall look at stock levels later. So the management would be involved in the planning because they know that the accountant has actually provided for us the quantity that we need. Then we can now look at what we have and we try to benchmark. Maybe they are trying to project what would be the next production as per the quantity they have received. So they are basing on what they have to benchmark what will happen. Therefore, those are the two disciplines. So there is a difference between management accounting and cost accounting. The cost accounting is just concerned with costing of the cost object. In other words, the products or services that the company is dealing with. And the management accounting would be concerned with the use of costing information to do management decisions, as we've discussed. We say that some of the management decisions, we say the management may decide that maybe we are trying to control costs. Maybe they may say we want to make a decision on whether to produce or buy. In other words, we are going either to buy the outputs, or we are going to produce these costs ourselves. So the cost accountant will provide the costing information for the production of those different products. Then it will be upon management to decide whether it would be profitable for them to produce, or it would be a wastage of time for them to produce, because they look at the costing and they say that according to the costs that we are going to incur, we would rather buy finished products so that we can be able to save time, especially when these finished products are going to be inputs in a given production process. So they may decide to, maybe there are some spare parts that they want to use in another production process. They may say that instead of producing these spare parts for us, they are going to just waste our time, because the costs that we are going to put in, it would be cheaper for us to just buy instead of producing. The other issue would be even controlling costs. Management would also try to control costs or cost control. Management may also decide, instead of incurring a lot of costs, and of course, me as a cost accountant, I will just compile the statements and I give to the management accountant. So you as a management accountant, you may realize that from these statements, we are incurring a lot of costs on such and such products or services. And you may advise the management either to close off some products that are not profitable, or to see how you can be able to minimize some of the costs that are incurred in different product lines, because you may find that some companies, let's assume maybe for Coca-Cola, they are producing so many products. You may find that a certain product is not coping up with the market. It doesn't bring up the turnover for that product is not all that convincing. You may say that let's terminate this project and we maintain these other products that we have, depending on the available information that was given to you by the accountant. Because also terminating a project involves so many things, because you look at it in terms of looking at the employees who are going to lose their jobs because you are cutting off the project. So some projects, they may not actually be profitable, but they leave them to operate just because the legal costs will be higher if they just terminate just because the product line is not actually productive. So we look at, those are the things that management may actually look at, and they make a decision basing on what their preferred objective would be. So that's why if they say that what are the roles of management accountant? So these are the same functions that we can put. It is just a matter of how you present them. But these are the same things that because the question may be, what are the functions of management accounting as a department? Or they may be management accountant as a person. So they are the same answers, but the way you phrase them or the way you state them matters. For example, if the question is all about functions of a management accountant, you may say that management accountant does the planning for the organization in order to achieve their objectives. And if they say what are the functions of functions of management accounting as a department, then you can say management accounting assists the organization in the process of decision making. So you can see how you can be able to play around with the same answers, but you are giving them in a different perspective. So that's basically what we wanted to highlight as far as the discipline is concerned. Now, management accountant, maybe to just get for you a brief definition, management accounting is concerned, is concerned with the use of costing information to perform management roles. And that's the definition, the brief one that we can give. So here, the discipline of cost and management accounting, they are being combined together because this person is providing the information to the other, and one can't work in isolation. So the cost accountant works hand in hand with the management accountant, and this is the main reason as to why you are here to study the skills and the techniques of costing and management accounting. And that's why you'll be eligible for the management accountant role in any organization. Otherwise, some organizations that have funds, they always separate these two disciplines, where you find a company with a cost accountant, they have a management accountant, and on top of those two, you'll find a financial accountant, a tax accountant, but they are all reporting to the finance manager or the CFO or the head of department or the director of finance, depending on whatever they call it in that organization. But those companies that don't actually have a lot of funds, for them, they just recruit one finance manager and maybe the assistant. And you find that that person is doing everything, meaning you'll be doing all the disciplines. Like you'll be the one doing financial reports, you are the one filing returns, you are the one who does the costing, and you are at the same time, you're the one giving decisions, acting as a management accountant. But literally, these two are different disciplines, though they are related somehow, because one can't work alone. And that's why we have a course unit called cost and management accounting. So that's how that was organized in that format. But for those doing SCCA, for them they call it performance management, but it is the same thing. At the end of the day, for them, they are more, maybe they got the name basing on the management perspective, because they are the ones that are within doing the evaluation and all that. But all they are meaning the same thing. So we need to look at now the roles or functions of management accounting as a department, because if we don't highlight some of these things, they get problems. So, but I'm just going to summarize them because we talked about them. One, we said they involve in planning for the whole organization. We also said they use the costing information, to do the control of costs. So they are also involved in decision making. So, and the decisions that you do as a management accountant, we shall see the decisions, but we have make or buy, dropping a product, how many units to produce of a given product. There are so many things that they look at and they make decision on. So we have talked about even pricing. They are involved in pricing. So where you as a management accountant, you are going to assist the organization to do the pricing, because the cost accountant has provided you the cost, has provided you with the costing information. So you have everything. You just look at the policy and you attach a profit margin so that you can determine the selling price. Then the last one is you as a management accountant, you will be involved in strategy, setting strategic decisions, because you have all the information and data that you need or that you can use. So basically those are the benefits of cost and management accounting, all the functions of cost and management accounting. And I hope now you can now differentiate between cost and management accounting. So, but there is another aspect that we also need to look at: the financial accounting. So the other side we have a cost and management accountant. This side we have a financial accountant. But here we shall handle only cost and management accountant or cost and management accounting. But financial accounting, we shall look at it as a different paper because it is a different paper on CPA course. But on the same channel, on the same YouTube channel, we have the tutorials that are on that financial accounting. So check out those playlists and have those videos. So let's stay connected to our YouTube channel. You make sure you click the notification bell icon to stay notified with the recent video uploads. So therefore, we need now to look at something else. We need to focus our attention on the two aspects: cost and management accounting and then financial accounting. We want to see how can we differentiate those two, because they may ask you to differentiate between management accounting or cost and management accounting with financial accounting. And that's why they usually ask that question in the exam, because it's the one that we are going to focus on and we'll see how we can be able to differentiate those. So which differences would you give if at all they ask that question? So if at all it happens, we are now going to look at the differences between cost and management accounting and financial accounting. So we need to, but these differences, we are just going to categorize them. We are going to come out categorically clear and say, this is the idea or the item. How is this item related to these two aspects? So let's start by looking at one difference. Number one, we are going to look at regulations. Regulations and standards. Now, we want to make sure that we understand regulations and standards as per those different aspects, so that we can be able to get the difference that we can highlight from those two disciplines that we have. So we always see from the newspaper that these companies, especially those that are listed, the ones we call public companies, we see that they publish their financial statements. And those statements are always prepared in the same format for all the companies, whichever company, as long as it is listed. they prepare the financial statements in the same format, or they use the same format. And it's not because they like it. It's not because it is the right way or it is the preferred approach, but they are following regulations and standards, rules, regulations and standards. And that means that financial accounting follows some standards and regulations or rules. And that's why we prepare financial statements in that same format. You find that you have to start with a certain item. And we are not starting with that item because we like it, but it is as per the standard. So you find that whenever you are preparing an income statement, you start with 11. That's it by standard. It has been standardized that way. So we start with a certain item, and it is prescribed by a certain standard. That's why we have to deal with that item in that same manner. And there is no way you are going to differ from what a standard is saying. And the moment you differ from the standard, then they will say you are not a financial accountant. Especially maybe for when these auditors, they try to review the accounts you've prepared. They may say that these accounts were not prepared as per the standards. In those standards, we may have the IAS, we may have ifrs. These are accounting standards, and we shall look at them when we go to, if you try to check our videos on financial reporting, these standards, they are there. So, but while or whereas in management accounting, cost and management accounting, you find that in management accounting, we don't follow any standards. We don't follow standards and regulations. Although we depend on what the users, but we depend on what the users want or what they need. So we are focusing on our users. If I'm preparing something for shareholders, what do they want to see? And it's what I'm going to be representing. So we follow the needs of our users. For example, a company may decide to have their cost statement. Maybe you may find that company A wants the cost accountant to prepare their cost statement starting with the direct costs, and then you end with the overheads. But when you go to maybe company B, you might find that the cost accountant there, they tell that person to start preparing with the overheads and then end with the direct costs. So, meaning those people, they depend on what the stakeholders want. we prepare these statements basing on what the stakeholders or what the users want. If they want to see the profitability, of course, it depends on who is asking the profitability. That's what they will go with. If it is management and they are only interested in looking at the overheads, they may prepare a statement that is only on the overheads. So we prepare something that we are going to use as the users. So we don't depend on any regulations or standards. So that's how you can differentiate that. The second thing that we may look at, because these ones we are giving differences. The second idea would be, our part B, we may talk about the main users. The main users of the information that we've prepared. So this is also another difference. And the main users of management, cost and management accounting reports are the top managers. So for cost and management accounting, the main users of financial reports or management reports are the top managers, because they are the ones that are going to make decisions. But the users of financial accounting reports are, we may have managers, we may have the public, we might have financial institutions, etc. So meaning that these reports, they tend to categorize the users of the reports. So under management accountant, you find that we have two categories of the users. We have the internal users and the external users. So management accounting reports, they are mainly used by the internal users. You will not find the revenue authority to start asking the cost statement. They will not ask for it, because they will only ask for financial statements for them to know how they can tax the company. So this information, the main users are categorically classified into two. The internal users are the ones that are focusing on the management accounting reports, and the external users are for financial accounting reports. And mainly in Uganda, we have the URA, Uganda Revenue Authority, the auditors, the public, and other government agencies, because they are the ones that are actually more interested in looking at how the business is operating. But these management users, for them, they just look at the costing aspect, because you may find that the management reports, they are just looking at the cost statement, they are just within the production department. But the financial accounting reports are actually for the whole organization, meaning whoever has an interest in an organization is going to ask for the financial reports. But for managers, they are the ones that want the internally generated cost statements that we are going to use for costing our products or for determining the prices and all the other things. So the main difference is that management accounting reports are never published, because you can't find when these management, it is very rare to find when these management accounting reports have been published. And even when they are published, they are supposed to be some notes that these are actually management reports. Because these are not mandatory, they are not supposed to be published, because the only people who are going to use it are the internal people, the people within the organization. So sometimes, even when these reports are audited, because sometimes they are not even supposed to be audited, but even when they are audited, they can't be published. And even when they are published, they have to put a note to clarify that what they are saying, they have to clarify to the general public that this is mainly for internal users. So we shall look at the internal and the external users later in this course, but for now, let's understand that the main difference is that management accounting reports are used by the internal users mainly, and the external users, they focus on the financial accounting reports. So let's go to number 3. There's the third difference. We may have preparation of reports. Preparation of reports. So it's not mandatory to prepare management reports, but it is mandatory to prepare financial statements or financial accounts, because for the companies, we need to prepare our financial statements for us to know the profitability. Even other agencies, when these guys are when they are taxing the business, they want to look at our profit. Have we made a profit or a loss? And the only way for you to look at that, you must prepare a financial statement. But it's not mandatory that we are supposed to prepare management reports. Management reports are only prepared when they are needed. Because you may take months without preparing the cost statement, because they may not ask it. Maybe the company is not producing. Maybe you produce once in a year, and maybe we assume that we shall prepare these reports at the end of the year. So it's mandatory to prepare. You can write it's mandatory to prepare financial statements. Statements or accounts. You may say or reports. And that's why you find some people actually forge those financial statements, because the time has gone, but they need the financial reports. So if they are not there, you find there are so many reasons as to why people can justify forging their financial statements. But you don't need to prepare the management reports. and only prepared when needed by the users. So, it is mandatory for us to prepare financial statements or financial accounts because it's an obligation to prepare financial statements since they are needed, and it's an obligation to prepare them every year, even publishing them, but especially for those that are listed. But for management accounts, they are only prepared when they are needed. Like if maybe your reports are on a weekly basis, then you can say, I'm going to prepare this statement maybe at the end of the week or at the beginning of the week. So you may find that your management wants these reports at the end of every week. So you do that on a weekly basis. If it is a monthly basis, then you also do that. So that's the difference. The other one, we can look at, there's some difference on this one. This is the performance evaluation. Performance evaluations. This one we need to be very careful with it because everyone does performance evaluation. Even us in cost and management accounting, we do what we call performance evaluation. But the performance evaluation we do under cost and management accounting is for a given department. We may say that let's do a performance evaluation for product A, for product B, or for product X or Y. But under financial, you can also do a performance evaluation for a department or for a function within an organization. But the performance evaluation we do under financial accounting is supposed to be for the whole organization. You can't find performance evaluation that have been done for the company and they are only representing maybe one branch. So you find that even when there are statements, they are prepared for the whole, even if the company is having so many branches, they combine them and then they do one statement that is representing the whole branches. If maybe it's a bank and it has so many branches, so the performance evaluation can't be for one branch, it's for the whole organization. That's how you can be able to differentiate it. But otherwise, both do performance evaluation. So financial accounting and financial management, we do performance evaluations. But the difference in the performance is that financial accounting looks at, here financial accounting looks at the performance of the whole organization or the whole company, whereas cost and management accounting will look at the performance of a department, a product, etc. And that's why you will never see any of your financial statements for, let's assume Standard Chartered Bank is publishing their financial statements for maybe one branch. That one will never happen. You will always see that maybe Standard Chartered Bank is publishing for the whole organization. But the management accounts, we can even look at the performance of just one product. If let's say it is Standard Chartered, they may say that let's look at the performance of our salary loan as a product for the bank, and other products are ignored. So it's a difference, but the way you phrase it matters, because both do performance evaluation. Therefore, financial accounting is mainly concerned with the performance of the entity as a whole, whereas management accounting is concerned with individual products, department, or sections within the organization. And that's how we can phrase it. So let's look at the next one. The next one we may look at is monetary and non-monetary information. Now, if you happen to look at management reports, they also look like financial reports, only that some assumptions differ. And also, since management reports are internal, then they can look at the information that is non-monetary. In management accounting, we may look at non-monetary items. Management accounting can look at non-monetary items, but financial accounting only looks at monetary information. Otherwise, something you can't quantify, something you can't put a value on, it can't be accounted for under financial accounting. But there is some note. We need to be careful with this, because we are seeing that there are some recent developments. You are seeing that we are seeing that we are now starting to do something called environmental sustainability reports, environmental reports, climate change, climate finance, those kind of aspects. So if it happens and they start incorporating those values, all those non-monetary, non-quantifiable items, then this difference may not actually make sense. Because we are seeing we have those these ones, environment, sustainability, and governance. So if these actually happen to be incorporated into our financial reporting, then this difference may not actually make sense on our side. So the financial reports cannot report about quality. It is hard to find financial reports reporting about quality of maybe the staff, the quality of the product. They only look at the monetary values. So even though there might be some signals that maybe there was quality issue, maybe the quality was low, even customer satisfaction. So those are the things that are very important to the business, but they can't be quantified. for them to be included in our financial statements. So, but under management accounting, you may find that we have what we call management reports, and there you find that even those guys who are in the quality control department, they are providing their reports on the department, yet they are non-quantifiable things. So thus management accountant gives both monetary and non-monetary aspects, whereas financial accounting does only the monetary aspects. But we need to be careful with the recent developments that are talking about environmental reports, climate change reports, sustainability reports. So in the future, if they say that in the financial reports, we must report information relating to climate change, then this would not actually make sense. So therefore, those are the differences that we can think of between cost and management accounting and financial accounting. You know, from this point now, you know who does the costing, you know the roles of management accountant, management accounting as a department, you know the person, you know the process of costing. But we have said that we also need to talk about stakeholders. Remember, we said we are going to talk about stakeholders later. And the stakeholders here, the ones that we want to focus on, are those stakeholders that are specifically for cost and management accounting. Meaning, remember we said that cost and management accounting information is mainly consumed by internal users. So we are only going to talk about one category of stakeholders. So you need to know who are the stakeholders and how to categorically say or tell where they belong, whether these are going to be internal or they are going to be external, because we have both external and the internal, but here we are only interested in the internal stakeholders, and I hope that makes sense. But of course, when you go on level 2, you are going to find the different categories of the stakeholders. You are going to find other things to do with ethics. But here, we are only interested in knowing some of the few things that we need to know, because this is just a starting point. So those other categories, we are only going to have them maybe on level 2 when we are doing the advanced of this paper, that is management decision and control, or advanced performance management for those that are doing SCCA. So now what we are going to focus on are the stakeholders. So you just need to know who are the stakeholders and how to categorize them into the internal and the external stakeholders. And I hope that makes sense. But of course, when you go to level 2, you are going to find different categories of stakeholders, especially when doing ethics. But here, we are not interested in those other categories, and you only need one category for the internals. So let's start with defining who a stakeholder is. Who is a stakeholder? A stakeholder is someone who has an interest in the affairs of the entity. So, a stakeholder is someone who has interest in the affairs or activities of the entity. That's what we call a stakeholder. And if it is a business, you have an interest in the affairs of the business. But the key point here is, what is your interest? In other words, the key item here is the interest. What is your interest in the business? What is your interest in that business? So let's discuss the stakeholders and their categories. So we put them in a category, but with their corresponding interests. And at the end of the day, we shall be able to know who are those that are falling into the internal and those who are falling into the external stakeholders. And when we are done, we shall be able to push for the real issues, because these are the theoretical things that we need to handle before we go into the computations. So we are just going to highlight them. Then at the end of the day, we shall group them into the internals and the externals. But at the end of what I want you to first understand the stakeholders. So anyone with an interest in the affairs of the business or the entity, because it may be an NGO. So one, we have the public. For the public, we need to know that these are the stakeholders, but the issue here is that we need to give the stakeholder and the interest. So what will be the public interested in the affairs of the business or of an organization? So we need to understand the interest of the public in our organization. The public is interested in how the company is conserving the environment, conserving the environment around it. So how is the organization conserving the environment where it operates? They may also look at sustainability. Sustainability. In terms of service delivery. In terms of service delivery. The public here, we are looking at the society. The public, we are meaning the society. In other words, where the business is operating. So that's the society around the business entity. So we are looking at the society and the entity itself. So that's the first person. We are just going to give very few things, then we look for another person. Another person, we have the regulatory bodies. Regulatory bodies, in other words, the government agencies. may call it government and other government agencies. So we have a lot of regulatory bodies like the NEMA. You see, these days NEMA is very common in demolishing people's houses, those who seem to have settled in wetland areas. We have, this is National Environment Management Authority. Then we have URA, that is Uganda Revenue Authority, the one that doing the taxing, and others. Because also we may look at URSB, Uganda Registration Service Bureau. So there are other things and what they are interested in the business. So since there are many government agencies, we are now using regulatory bodies interested in compliance. So all of these guys, they are interested in compliance. If it is NEMA, are you compliant? That are you not setting your business in wetland areas? Are you following the environmental rules that they set in place? So if URSB, have you registered your business? If it is URA, is the company paying taxes? Are you doing the proper recording of the transactions? So those are some of the things that they may be interested. They are interested in compliance with the standards that they have set. Compliance with given standards. That's their interest. Then the other one we may look at competitors. The competitors, those are the people you sell similar products, maybe in the same line of business. And their interest, of course, they want to look at your products. Because even competitors, they can buy your own products. And they try to do what we call reverse engineering. They try to study your product so that they can see how they can improve their products. So the competitors, they are interested in your product to see how they can compete with you. Because competitors, they can also buy the product and they do reverse engineering. We shall look at reverse engineering. Maybe when we go to level 2. We shall look at reverse engineering and we'll see how the competitor can actually buy your product. They study your product by opening every ingredient and then they modify your product into a new product. So that's what we call reverse engineering. The other one we may talk about, we have the suppliers. These are people that are supplying us goods on credit. So what is their interest? The people that provide materials, goods on credit, and their interest is to see that the company can pay their money promptly, on time, for the goods supplied. Supplied on credit, on time, or promptly. Is the company capable of making payments for the whatever items they have received on credit? So that's their interest. Then we also have financial institutions. Like banks. These are different from suppliers because suppliers, they supply materials and goods. These banks, they supply money or they supply finance. They give us funds. They are the fund providers in terms of loans, and their interest is to see whether we can pay back their money on time. The other category we may talk about are the shareholders. Shareholders, their first interest is dividends. They are putting in their money and they are giving it, maybe they are giving out to the CEO to make returns. Those returns, they are the ones they are looking at. Is the company capable of paying us dividends? Then they may also look at market expansion and even long-term survival. Long run, they look at, can this company sustain us? Or can it be sustainable in the long run? So these are the people that provide us equity finance. And their interest in the business is the return on equity supplied. So they follow things. These other things they just follow, but their first interest or their main issue is to make sure that they receive their returns on invested capital. So they may also look at maybe business expansion. Can the business increase its market share? Then sustainability in the long run, whether the business can actually survive for a long period of time. Then the other people we may look at are the employees. Employees, of course, they are interested in their salaries actually. Can the company still be able to pay their salaries? Then at the same time, if the company can actually pay their salaries and wages, then the question is, for how long? Is it sustainable? That's what we call job security. Can the company be there for a long period of time? Are their jobs safe? Are their jobs in the long run? That's what they look at. The other one, we may talk about the managers or the directors. They call them directors or managers. These directors or the management, these are any person that is managing a given department. And their interest, of course, for them, they look at the financials. And they want to know, can the company survive? For them, they look at the financial and the non-financial information to take decisions. Then the question is, can these decisions, or are these decisions they are making, are they going to keep the company operating? Because their issue is to make the company operate and they keep on earning their commission. Maybe someone, they gave them a business and they are paying them by profit made. So is the company making the profit they want, so that for them they can be able to earn their bonuses and all that? Then the last category that we may talk about are the customers. Of course, customers, these are the people that buy goods that we produce. So their interest is about quality. Are they able to receive quality and even quantity itself? Can the organization be able to supply the quality products? And can the supply be there is there a consistency that they are going to be receiving the right amounts they need or they can afford for? So we said cost and management accountant, we always focus on. Now the gist of the matter is here. For cost and management accounting, we focus on only the internal users or stakeholders. So among the ones that we've provided, we need to make sure that we categorically give or state these items clearly, that the internal users, they are the ones that we are interested in. We are only interested in the internal users. Internal users or stakeholders. So even when they give you a question, make sure you first give out the internal users, then you can put 2 or 3 of the external. So we need to clarify and give the internals and the externals. So the internal stakeholders, we have the directors. We have the directors. We have the directors, stock managers. We have the employees. Because these directors and employees, they are the ones that are involved in the day-to-day business activities. Though you may analyze that directors, they are those that are external and they are those that are internal. But here we don't internalize, because they are those, someone will be saying we have non-executive directors. They are not within the company. Yes, but here for costing and management, we don't internalize. We just take the directors to actually be internal, because they are the ones that are doing the management. So these are mainly the people that are actually going to use the information. Now, so that was like an introduction. In other words, it's like a second introduction, because we have already given you lesson 1, but this one is just to give you the discipline to introduce the 2 disciplines of cost and then management accounting. So I wanted to introduce to you that you get a brief understanding of what we are dealing with. So now that we've understood that, we need to look at how best can we be able to present the costing information. In other words, we want to look at the costing statement, or someone may call it a manufacturing account or a cost sheet. So you can maybe take a break of, let's say, 8 minutes. Break of 8 minutes, but when we come back, we start from cost statement, or what we call a cost sheet, or a manufacturing account. All these are meaning the same thing. Because a cost statement is showing costs. Costs are within the manufacturing department, and that's why we call it a cost sheet, a cost statement, or a manufacturing account. They mean the same thing. So just stretch your legs and we'll come back to push this other part. Now the cost statement is presented basing on the classification of costs. It is basing on the classification of costs. It is classification of cost by behavior. Classification of cost by behavior, where we have the variable costs, we have the fixed costs, and the semi-variable costs. But here you are going to find that at times it depends on the examiner's requirement. For example, when I say that prepare, when the examiner says prepare a statement clearly showing your variable costs, fixed costs, and maybe the semi-variable costs. Or they may say prepare a statement clearly showing your variable costs and overheads. So whichever way they have examined the question, make sure you do what exactly they have asked. Because remember we said you as a management accountant, your role is to generate information depending on the needs of the user. So in this case, the examiner is going to be our user. Whatever they tell us to do is what we actually do. So the examiner may say, I want you to just have the variable costs and the overheads. Or I want you to be showing the variable costs, the fixed costs, and maybe the semi-variable. So whatever the examiner has said is what we do, because we are depending on the user's need. So the users want the cost statement to be based on fixed and variable costs. In other words, we have the fixed and the variable ones. So at times, it depends on the required answers from the examiner. Otherwise, if things are normal, then the statement would be in the following format that we are going to talk about. So if the examiner doesn't actually tell you which format to go with, you make sure that you follow this general format. So we can have the format of a cost, let me call it a cost sheet or a cost statement. So we need now to look at the cost format, the cost statement format. So we always say we generate two columns. Let's go to another slide. Here we are looking at the format. Of cost statement. So we always want you to generate 2 columns. So we generate 2 columns. Let's say this is our first column. Those are the columns that we've generated maybe. So we have 2 columns there. And in those 2 columns, we have to make sure that we can minimize the numbers, because you may find that the figures are going to be very big. So we can try to minimize the numbers. So we can put in the amount, the currency. Maybe we are in shillings, and let me put the thousands in brackets. Shillings, then the thousands. So those are the 2 columns on your right hand side. So this one is the column for details on narration. On narration. So the figures may be in thousands, figures may be in millions, figures may also be in billions, depending on what the examiner has given you. So don't cram that the values are supposed to be in thousands alone. Secondly, don't use a ruler here to draw these lines. This is not financial accounting. You just have to just put in the figures in an orderly way, not just by using rulers and all that. So to draw these columns, you can just use your natural eyes. So I'm putting these columns and I'm drawing these lines, but these are not supposed to be in tables. I'm just creating a format, but these are not supposed to be in tables. So let's delete them. They are supposed to be like the way you have seen. Oh, here we can also remove this and we just remain with the details. That's how it's supposed to be. You don't supposed to draw a table. I'm not saying that if you put it in a table, they cross it. No, but it looks very fine when it is like this. So those are the details that we have. Now, this looks like the financial reports, but though these have information on 2 columns. So we start with A, category A. The category K, or the first category of costs that we are going to look at, are the direct costs. Direct costs. That's the first category that we are going to look at. And another name for the direct one is called prime costs. So we shall put that prime later, but just note it's called prime. Prime cost, we saw that word already. So these include, now we start giving the details of what is supposed to be included in the direct costs. One, we have raw materials. We have raw materials, and you just put the material cost. So we put that figure this side. Now, the raw materials may have a formula, because we have a formula to compute these materials. We have a formula to compute these materials. So because for you to get the materials, we have the opening stock of raw material. We add what we've purchased. So on this one, we add purchases of raw materials. So this value, we may wait to put it there, but just know the final figure is going the other side. So then on this one, we have carriage. Carriage inwards is like transport. You are transporting the raw materials. The cost we incur for transporting raw materials, we add it. Then on this one, we have to less closing stock. Less closing stock of raw materials we put in the bracket. So the answer we get, we take it to this side as our figure for material cost. That is the figure for material cost. So we have a format for that. Material. So there is where you'll be having maybe returns. If you have return outwards of raw materials, we also less it from here, because you may find when there are returns, to give us the material cost there. So material cost always has a format for it. And the figure we've carried this side is what we call the total material cost. So we look at other item. Other item that is within the prime cost or the direct cost. So direct labor. This is our second line item for direct cost or prime cost. And this is a matter of understanding, because in an examination, you may find under direct labor, you have both skilled and unskilled. So you may find under this you have unskilled, and then skilled. So just bring this unskilled here, then skilled. Skilled labor. so that you can be able to get the cost for direct labor. So when you see that, then that means you will need these two lines, the line for skilled and the line for unskilled. And of course, you have to put this under the first column. We put these ones under the first column to make sure that we are adding, and it is only the total I'm putting at the end, this side. So this extreme end is the total direct labor. So we go to the third line item, that is direct. We are still on the prime cost, direct expense. So it's not a direct, if it's not a direct material or a direct labor, then it's supposed to be a direct expense. So this is not a direct cost, but it is a direct expense, because there is a difference between these two items, the direct expense and the direct cost. Remember, we said there is a difference between an expense and a cost. Because it may happen whereby someone can incur a direct cost that is expensed in the income statement, or you can incur a direct cost that is not expensed in the income statement. So we have those revenue expenditures, they are the ones that we expense in the income statement. So the capital expenditure we don't expense, however much it may be a direct cost. So this is because when you are expensing something, you match it with the revenue or something. If you're not matching it with the revenue, you're matching it with something else. And it will never go to the next accounting period. Meaning, if it is an expense, it's supposed to be an expense and it will never go to the next accounting period or the next 12 months. It's supposed to be finished in that same month. That's the expense, because we are expensing it in that same month it was incurred. But for a cost can go to the next accounting period. It may be an asset. So therefore, cost can be an expense, but not all expenses are costs. And that's a matter of understanding it. You learn these things when we do stocks and other things. But for now, let's just say that direct expense is our third category or third line item for prime costs. But however, you may find a number that has many direct expenses. So this would mean that you have to list them here. Maybe someone has hired a crane for lifting loads and all that. Those are expenses. So when you have them here, you list them and you give their totals here for each of the line item. Then you sum them, you take the total this side to be the total direct expense. So you do the same thing just like what we did for labor, where we added the unskilled and the skilled one. Now, so those will give you the figures here. But now, we have to come to this point. We sum up the first item, all these three line items, the direct material, the direct labor, and the direct expense. So when you sum them up, what you get is what we call the prime cost. Or the total direct cost. But we prefer to call it the prime cost. Total direct costs. And that's our figure. And I understand that in financial accounting, you always do your manufacturing account with 3 columns. So we do it in a columnar format. We put some columns and we put in those values. But here we use 2 columns, and that's okay for us. So let's just maintain this to be our prime cost so that we don't congest these figures. So now we go to the second category, because the other category was the prime cost. So we go to B. B is our overheads. And another word for overheads, we call them indirect costs. Costs. Remember, we've been on the direct costs. Now we've switched to the overheads or the indirect costs. And these also form the same format of the direct cost. In other words, we are just going to duplicate the direct costs. So how are we going to do that? Let's go to the next sheet. We have here the indirect material. We are going to follow the same format, indirect material. The challenge is that these guys may not tell you that this is an indirect material. So you need to differentiate between direct material and indirect material. The indirect material cost is a cost that which cannot be traced directly from the production or from the service. In other words, you can't trace it to a cost center or a cost unit, or you can't trace it on a given product or service. So if there are many items, then you have to add the list up so that you can be able to get the indirect material costs. So you get your value here. If there are many, you first sum them up from here. First column, you sum them up, then you get your total indirect material. So that's the first line item. Remember, we are duplicating the other format for direct material. So we go to indirect labor. Direct labor, we do the same thing. If there are very many, you do the same. Then you bring the total value here. Then the last one is indirect expense. You bring also the figure here. So those are the costs that we are adding. So we add them up, and then we shall get what we call the total overheads. So when you sum these values here, this one, and this one, we get this value here, and that's our total overheads. So we add, to get the total overheads, we add the indirect labor, indirect material, and the indirect expense. And from there, we go to the other section where we add. From this point now, we come and add opening stock, or we call it opening work in progress. Opening work in progress. We put the figure there. We add it. And then we less what we call the closing work in progress. We less closing work in progress. We less it. So there is there is a trick here. This is mathematically wrong. If you say less and this one you come and put it in the bracket, it's like you are adding, because a negative and a negative. So here, if you say less, this one you don't put it in the bracket. But we are used, because if you don't put it in the bracket, you may forget, and when you forget, you'll make errors, because if you forget to put it in the bracket, you may just add everything, and you forget to deduct it. That's why we are putting it in the bracket. But since here we are not doing mathematics, that will be fine. So after listing off the closing work in progress, and that's what we were doing by the format. In other words, we went through all the format that we wanted to do, and we are putting all those values in the format so that we can be able to get these costs here. So the format goes to that point. Now, after getting these values, we've left off that. What we get is what we call the manufacturing cost. Those are manufacturing costs. Whatever we get here is our manufacturing cost. So the manufacturing cost, in summary, are equaling to the direct costs. They are like the direct costs plus the indirect costs plus opening work in progress. Work in progress. Then minus closing work in progress. And that's what we are doing in the format. This is whatever we've been doing, and that gives us what we call the total production. You can call it total production costs, or manufacturing costs. So that's what we've been doing above in the format. So the examiner will use the costs statements, like generating the cost statements, which means a statement is indicating the cost of production or the manufacturing costs. They can also say determine the production cost. It's a manufacturing account if they say determine the production cost. Therefore, the manufacturing costs are the same as the production costs. And at times, they say it is called factory costs or the cost sheet. So the above represents all the costs that we have incurred to manufacture what we have in our warehouses. And everything has been elaborated in that format. Now, at times you may do a manufacturing account, and then they ask you to determine maybe the profits. They can also ask you to determine the selling price. Just from that point, from the point where we gotten the manufacturing costs, they can continue the question to say that you go ahead and compute what we call the selling price or the profit. But remember, these we only get these from the use of markups and margins. So we use the principles of markups and margins. So what we are going to look at now is looking at the margins and the markup principles. We want to see if we have the manufacturing costs, all the production costs, all the factory costs, how can we be able to reach to our selling price? Or how can we be able to get the profit component that we can add to our costs so that we can get the selling price? So that's going to be through the use of the markups and the margins. That's the principle that we are going to use. So let's go ahead and see what we have. So markups and margins. So let's take an example. If you are to understand some of these things, if a company wants 20% gain, that's a profit. If a company wants 20% of a gain, for example, this would mean that the 20%, sorry, the 25, we've used 25%. 25% of a cost, that is the interpretation of this. It means the company has incurred a cost to produce a product, but on that product the company wants 25% profit. So what that means is that the company needs 25% of its cost it has incurred. In other words, we get the 25% of the cost so that we can be able to get the profit component. Therefore, what they will do, they will get the 25% and they will apply that on the cost, and that becomes the gain. So you can see that we have computed the manufacturing, sorry, we have computed the gain by just getting the 25% of the cost. So we've computed the gain basing on the cost. So every time that we get a gain when basing on the cost, then we call that as the markup. So every time we compute a gain on cost, that means it's a markup. Therefore, a markup is a profit expressed as a percentage of cost. So is a profit expressed as a percentage on cost? So every time we compute a profit on a cost, it means we are computing a markup. So a profit expressed as a percentage on cost means to get the markup, it will be the profit over the cost, then we multiply by 100. So this will be, the markup will be the profit over the cost times 100. If you want to compute the markup, it will be profit over cost times 100. That's the markup. Because it is a profit expressed as a percentage of cost on cost. So we are multiplying by 100% just to make it a percentage, to convert it to a percentage. But we also know that cost of sales, we know that from our accounting that cost of sales is the cost you have incurred to make whatever you are selling. So cost of sales is a representation of the cost that we've incurred. Meaning down here, we shall have cost of sales. So if in the question you are not seeing costs, you will see cost of sales. So for the profit, it will be our gross profit. Because we know that cost of sales will be the gross profit plus our sales. Because we get sales minus cost of sales to be able to get the gross profit. So that's how we basically get those formulas. But now we need to understand, how do we get profits when we ignore the costing aspect? So we want to ignore the costing aspect, and we use the general knowledge, what we know. So if you try to ignore the costing aspects and we just use our general knowledge, we know that profit can be equal, or profits equal to revenue minus costs. That's how we get a profit from our general knowledge. So this one, since we are dealing with only one unit, now we are considering only one unit of output. So if we are dealing with one unit of output, then it means our profit is going to be, the profits are going to be the selling price per unit minus the unit cost. In other words, how much do we incur to produce 1 unit? So it is the same principle. These are the things that we know from our general knowledge. We don't need to have any accounting information for us to understand this. We know that if we are dealing with 1 unit of output, let's say 1 bag of sugar, we know we've put in this cost and the selling price for sugar is this. So how much have we made as a profit? Get the selling price minus the unit cost. We know that. But now we want the price or the revenue. In other words, we want the selling price. If we want the selling price, what we are going to do, it will be, the selling price will be equaling to profits plus the unit cost. This is what I've been explaining. So what we need now to do, we've understood how we came to this general information. Now what we want to do, we want to see the applicability of these results that we've gotten. So what we are going to do, we are going to do a number. We are going to do a number. And they will ask you for the cost statement. And then they will tell you that the company policy allows a 20% markup. And that's what you will find in the question. And then the required will be saying determine the required will be to determine the selling price. And I hope that makes sense, because that means the only way to get the selling price is by getting your total costs from the cost statement, and then you add up your profit. So when you add up your profit, so that you can be able to arrive at the selling price. So the solution here would be, we shall get the manufacturing costs that figure that we computed from our cost statement. Then we add the profit. But this profit is going to be basing on the markup. We add it there, and that will give us the selling price. That will be our selling price. So the reason we are splitting this computation is depending on what we have in the question. Because you may do a question that has maybe Roman 1, Roman A, number 1, part A, Roman 1, requiring you to do the manufacturing account, and Roman 2 to determine the selling price, or you can do a question, let's say question 1, where it's combined and it is asking you to determine the selling price, meaning you will not close the cost statement until you have computed the profit and close at once with the selling price. And of course, you will see these questions as we try to attempt some numbers. So that's all for the markup. That's all that we wanted to talk about for the markup. Now I want to focus on the margin. Let's look at the margin. The margin is a profit. Everything is talking about a profit expressed as a percentage on sales or revenue or turnover, whichever that has been given the question. So this means if I want a margin will be equaling to the profit out of sales times 100. So we multiply by 100 just to make it a percentage. And that's all for the margins. But now the trick is always on a case like this. You may find that the examiner, what the examiner will do, they will ask the same question just like the way we asked it for the selling price. And they will give you the margin. The examiner will give you the margin. Let's say 20%. But remember, you have done the cost statement and the selling price for you, because now when you have just done a cost statement, it means you've gotten what we call the production costs. And you find in the question they're asking for the selling price. So for you to be able to get the selling price, you need to first compute your profit component. So for you to be able, because you have computed production costs, you can't apply a margin. Because a margin is applied on sales, and what you have, you don't have sales, you have production cost. So which means that you want to look for a markup. You want to have a markup, but in the question they gave you a margin. So which calls for the skill of how to convert a margin to a markup. Because the margin that they have given you, you can't apply it direct to the manufacturing cost figures. Since we don't apply margin to costs, you only have to convert the margin to markup and then use the markup directly to the production cost or the manufacturing costs. However, it can be given to you you may find that the markup has been given to you in the question, and it is very direct, as we shall see from the past papers. So if you find that it has been given to you, then it's okay. You don't need to struggle by converting. But if it is indirect, instead of giving you the markup, they have given you the margin. So when it is indirect, what we do, we need to learn how to convert from either side. Either you are converting from margin to this or from markup to. However, it can be given to you as direct, as we will see from the past papers, and it can also be indirect. So when it is indirect, what do? So we need to learn how to convert from either side, either from markup to margin or margin to markup. So without wasting more time, let's look at how can we convert from markup to margin. So if they have given you a markup, so if they give me a markup, and I need a margin, for example, if we have A over B under markup, and then we want to get the margin. So we will be doing, we shall do like this. We shall maintain our numerator as A. We divide that by, we also maintain our numerator B, but we add A. That is a numerator. So that will be what will help us to be able to get those values. So what we mean is that we maintain the numerator. The numerator here becomes the numerator here under margins. The denominator also remains the same, but on the denominator we add this numerator A. So for example, if let's say we have a markup of 25%. So we want to compute a margin. What will the margin be? So that means we shall have 25 over 100 because it is 25%. This means this 25 will be our A and this B will be the 100. So to get the margin, we shall get 25 over 100 plus 25, and that will give you 25 over 125. So this will give you 0.2. So that is 0.2 times 100 will give you 20%. So the margin will therefore be 20%. So it is very true that a markup of 25% equals to a margin of, so a markup of 25% equals to a margin of 20%. It is very true. And we've done the illustrations here. So we have to be very careful on this because we are going to face either this in multiple choice questions or with our essay. You can find this anywhere, either in our section A or section B. So we have to get the principles of the markup, and also we have to get the principles for the margins. So since we have the two principles, we are going to start with something direct, since we have the knowledge already. So let's do some material costs, since we have the knowledge that we are familiar with, and after we shall do labor and overheads. So from the above, we are only left out with the interpretation of the analysis. We've known how to compute, how to convert those values. But this is the main important one. Coming from a margin to a markup, it is just the alternative way. We can maybe just convert that faster. Converting from a margin to markup. This is very direct because we have the margin here. We want to go to a markup. Let's assume that this is A over B. And if you are to go this side, what we shall do, we shall maintain our numerator as A over B minus A. Then we multiply by 100 to make it a percentage. So that's how we shall get it. If let's say you have a margin of 20%, let's just use the same example. Then what will be the margin, the markup? We want to make sure that we have a markup of 25% because that's what we got from last time. So this one will be 20 out of 100, and that will give us a 20. We maintain the numerator as 20 over 100 minus 20. So that will give you 0.25 times 100, you will get 25%. So that's how we do the conversions. So finally, we've understood how to move from margins to markup. So we always do the opposite. If we are to move from markup to margin, we do the opposite of what we've done here. Instead of subtracting, we add. So the introduction, this introduction that we've gotten is actually enough. So what we need to do, we need to do something new. Let's look at maybe material costing. Let's try to have some principle on material costing. Then we shall be able to do some practical numbers after that. Let's do some introduction on material costing. So we are going to go to material costing. So what you should expect under material costing is that under this area, expect to learn about source documents. Expect to learn about source documents that are involved in the process of acquiring materials. So that would be our key emphasis. Expect the dispatching. These are also dispatching of the materials. So these are also source documents. We shall look at the documents that we have in here. So we shall also learn about inventory management. We are supposed to learn storage of materials. There are things to do with inventory counting or stock taking. Inventory counting. There are some bit of double entry, but this one we shall not look at it more in detail. So things to do with double entry, we want to look at it. We shall cover it at once, since we have a topic about double entry, and I don't want to teach double entry in bits. I just want to teach it at once. But for today, we are only going to look at the source document. Today we are going to focus on these two source documents that are involved in the process of acquiring materials, even dispatching of materials. These are the remaining bits, we may talk about them later. So the source documents for now, because I'm very sure that most of you are actually aware of the source documents that we are going to talk about. And no one will ask you to draw a format of any source document. Although some books, they may actually give you the illustrations, all the different formats for different source documents, but those are for you to actually learn, but they will not ask you to draft any of the source document. I want to be clear on that. So what we are going to focus on are the source documents. So a full organization or a company will have departments. And for example, in that case, we say organization structure, showing how the company is organized. So the organization will have departments, and these departments will represent the organizational structure. The organizational structure will be showing how the company is organized. For example, we may assume that in our company we have departments, and the departments we would expect, if at all your organization is arranged into departments, we shall expect departments like finance. Maybe we can say finance and administration. We include in even the HR department there. We can have procurement department. We have sales and marketing department, although some of them, they may split those two, but let's combine them. We have production, let's say production and stores department. Oh, that's enough. We can just say production department. etc. There may be other structures. Although here we are not going to study organization structure, but I'm trying to bring up the concept. Here we are not going to actually go through the deep understanding of how the organization is going to be organized, either by function, activity, or whatever. No, here I'm just trying to bring up the concept. Now, as per the organization structure, I'm only interested in this department. The production department is the only department that I'm interested in, because that's where the production manager comes from. Here we have the production manager. So under the production department, we may expect other departments under the production. So under the production department, we may have the production department, we have the production manager. But under this, we may also have other departments like the quality and quality control department, research and development department. We have the stores department. So this is also the stores department. It is under the production department. But now from here, I want to put more emphasis on the stores department. This stores section. The stores section of the production department. So, you as the production manager, you have targets, you have schedules that you are going to work on, and you need raw materials. Because in the production, we expect production to be taking place. So you need raw materials, which are supposed to be requested from the stores section. So these raw materials are going to be asked from the stores section. This stores section, I'm talking about the stores section for a formal company or organization. We are not talking about these funny companies. Maybe they have just started, they don't even have a stores department, or they don't have even a store, warehouse where they store their whatever items they have produced. So the production manager will have to raise some document, because even the stores person or the stores manager will be required to account for the materials in the store. That means this production manager is going to make sure that he raises some documents to the store. We shall have some documents, because those documents they are going to help the stores person for accountability. So the production manager is going to request the raw materials using some documents. We may try to illustrate this. The production manager needs raw materials from the stores. Stores person. So this person here, the production manager, is going to request for raw materials. And the reason is why he's requesting for those raw materials is because he has some schedules to work on. He has schedules and targets or targets. But as you request for raw materials, you have to submit documents. And these documents are going to be taken to the stores. So you make request. So this one is going to supply the raw materials. But in the end, this person is going to be providing some documents to the stores for accountability. Because also the stores department has to keep those documents to account for the raw materials that is available in the store. So there is accountability here. And it is the accountability that is requesting for those documents that are raised by this person here. So that's the whole story. So the production manager will request, and the request will depend on the targets, schedules, or objectives. And they are the ones that are forcing the production manager to request for raw materials or for materials through raising what we call a store's requisition. So that store's requisition becomes a source document, and that is the source document number 1. But since the warehouse has many products, they may choose to call it a material requisition, because you may find that the warehouse has so many materials. They are materials of finished goods. We have work in progress. We have also the same raw materials that haven't gone into. So the production manager will raise a store's requisition. But since there are very many things in the store, they will call it material requisition. So the first document will be store's requisition or material requisition. And you'll find that other books may call it a material requisition form, a material requisition note, a material requisition document, whatever they call it. But as long as it's a requisition form, requisition document, requisition note, it means the same thing. So if they ask for those maybe stores requisition document, don't say we never studied for that. So these all mean the same thing, but it depends on the company, because you may find that our requisition department, we may call it stores requisition, but that requisition has a line for the type of the raw material that we are taking. You may call it stores requisition, but in the description you put there the product that you are taking or the raw material that you are taking, the name of the raw material. So even if they ask you which parameters would you find on a material requisition form, even if you don't actually know, you can't fail to raise at least 2 parameters. Because we expect on this document, we expect in the examiner is supposed maybe to ask you what it is and maybe some characteristics or features. So some of the features you can't fail to put quantity because we expect quantity to be there. How many are you taking? Then we need also to know which department is requesting. So the requesting department needs to be present. We also need to have date. For accountability, you need to know on which date. Then secondly, we have to look at the type of the material you've taken. Because there are so many materials in the warehouse. So we need to know the type of the material you are taking. So don't waste your time struggling to study some of these things, but just have the concept and you'll be good to go. Because they will not ask you to give all of these things. We can also have the column for amount. For accountability, amount may be in terms of the selling price or the cost they paid. So if they tell you to write short notes about material requisition note or requisition form, then all we know it is just a document. Let's just write something just to define material requisition note. It's a document, either document, a note, whichever you call it, it will work. It's a document that is used to request materials from the stores. So it is the document used to request for materials in the store. From the store. It's the document that is used to request materials from the store or stores. So we would simply say it is a document, it is a note, it is a form raised by the production department requesting for raw materials. Or it is the document sent to the stores department. Or you may say it is a formal document raised by the production department or the production manager and sent to the stores requesting for raw materials. So it is a matter of understanding who raises it and sent to where. You know the function and then the features of it, and there you are good to go. Now that the store's person has received the store requisition form from the production manager, then what happens after that? Because what happens is for the store's manager to actually check in the store to see what is available. So the store's manager will go and check what is available. If they are not there, the material the production manager is asking, they are not there, that person will actually go and buy. And we shall start the process of procuring. If they are not, if they are there, then we see which documents may be raised from that point.